welcome everybody to our presentation on the why and how to passive real estate investing. I'm going to go ahead and remove my camera. I just wanted to say hello to everybody and thank you for joining us here. And I do want to make sure that we have time to answer any questions that you have. I am a real estate investor myself, so a lot of what I'm going to share with you is from a personal perspective over the last 25 years or so. So let's go ahead and get started. Now, first off, I do need to have a quick disclosure. This is not an offer to sell or buy any security for you. That has to be done through a private placement memorandum. And if you do find some interest in what we're doing, we'd love to follow up with you later and make sure we supply the proper materials to you at that time. So let's go ahead and get started. In order to get started, let's talk about today's environment. And these are things that everybody is familiar with, especially at the Money Show. We have heavily correlated markets right now. Diversification is tougher than it's ever been. Even crypto seems to be tracking with the stock market, which is rather odd. But that is an issue we have. We obviously have massive inflation. That is not transitory. That is not going away. The question is, how long will it last and what do we do about it? Real estate's a great solution there, and I'm going to share that later in the presentation. Obviously, taxes are always a concern, and we need to invest with taxes in mind, not purely with return in mind. Obviously, if they both match up, that's a win-win. That's one reason we love real estate so much. So today's solution is obviously investing in private real estate. I want to explain the why, the how, the what, the where, and all of those questions to you today. So let's get going. So the benefits just right off the top are this right here, diversification. So real estate does not trade daily. I don't have a new value that can be affected by any global panic selling that happens in the equity markets. That's a nice thing there. We have a value when we buy it. We have a business plan, and we have a value when we sell it. So the nice thing there is you do not have the ups and downs that you would have in a daily valued security, and we get cash flow. That is the nice thing about owning real estate is you generally get 4 to 6 to sometimes 8 or 10% cash flow. And it generally pays out quarterly, but it's a much higher payout than you would see in a typical, dividend in a stock, for example. Less volatility. We say that now, real estate does have bubbles. We obviously remember 2008, but it has less of them than we've seen in the equity market. So it generally, if you chart this, which I don't have for you today, but if you chart it over a long period of time, it is less volatile of an asset class. It's asset backed. And that's why a lot of the wealthy will do this. They love having physical, tangible assets. Asset backed investments are really the place to be going forward, especially in inflationary environments. And that leads me to the next one, inflation. Multifamily is a great place to be for inflation because it can raise rents fast. You can keep pace with inflation. A lot of what pushes values are the inflation that we see, and the values of the real estate go up as well. And then there's obviously great tax advantages. I'll explain this in a minute, but investing in a real estate deal is in a private placement or a private partnership, and therefore the tax advantages flow down to the investors and they'll show up on their K1, and you get to take advantage of all those losses that the depreciation and other things create for us. So let's move forward. The case for real estate. I always say, look at the pros, look at the smartest people in the business, the people that run these giant government and state pension plans, these giant endowments and foundations. Look at Yale, look at Harvard, look at the Ivies. The biggest pools of money out there, the insurance companies, where are they investing their money? And this is a neat chart. You can see from 1990 to 2019, the growth in alternative assets as far as the asset allocation for these folks. Always say it again, look at what the pros are doing, model our own portfolios after that. Unfortunately, this cuts off in 2019 because I would even argue the biggest growth that we've seen is in the last 3 years due to the inflationary environment that we're in. So obviously alternative assets is a little broad. Real estate is one of the largest pieces of alternative assets in addition to private equity. Next up, inflation. Inflation is a significant issue for us right now. And inflation is it's an interesting thing. So if you look at this graph, we look at the last 3 inflationary timeframes, and we looked at what people did or what could you have done to counter the inflationary period that we're in. So first off, 1973 to 1979, gold was what did really well. Well, why is that? We fully came off the gold standard in 1973. Everybody poured their money into gold and it did really well. We've since normalized, and that is no longer the case. People have gotten comfortable being off the gold standard. And if you look at the next 2 inflationary moments here, gold didn't help you very much. Next up, commodities has done very well with the exception of the 80s. And then real estate's kind of been the steady Eddie there. If you look at it, real estate is a great place to be in inflationary matters. Like I said earlier, the things that drive inflation or that inflation drives also drive up the value of real estate. Now, how does this fit into an asset allocation? We get asked this a lot by our investors. This is not a perfect chart, and there's various versions of this out there. But what this does is generally real estate will fall in between stocks and bonds somewhere. Now we're stereo typing. We're kind of averaging this out. Obviously, there's different types. Now, unfortunately, this chart is only through the end of 17. It doesn't change a whole lot with one exception. Hedge funds have dropped. Hedge fund performance is not what it's historically been. So we would drop hedge funds on here, but we feel that the rest of it is pretty accurate to where we see things today. So as it fits in your overall asset allocation, I find that this chart is valuable to kind of understand from how it would fit in your portfolio. Now, real estate has different sub-asset classes as well, and I find this value. You have core, you have core plus or value add, and then you have opportunistic. So what does all that mean? Well, as you can see from the chart below, the further out you go, the more risk, the more return you can gain. So first off, core. That's a stabilized, fully built, fully occupied property. And all it's doing is there's nothing to do. It's just spitting off income. It's full of tenants. It's full of, it's like either a multifamily property that's fully leased or a building that has long-term tenants already signed and they're in, and they're just paying their rent every month. So that would be what we would call a core strategy. Lower risk, lower return, very much more stable than you would say the others are because it's got the leases and there's not much to do. Then you'd have core plus. That would kind of be, so if core would be your central business districts, for example, or a brand new property, then core plus would be on the first cut. Maybe it's just a little bit further out, but it's the same kind of thing. Value add. Now, value add, you're going to hear a lot about, and I know there's some other sponsors at the Money Show talking about value add. Value add are renovation projects. So I know there's a lot of TV shows on about single family home value renovations. The same is true in the commercial space. So it could be an office building, it could be a multifamily property, it could be a warehouse, it could be whatever. And what you're going to do is you're going to find something that's, call it 15 to 20 years old, and you're going to buy it and you're going to renovate it and you're going to make it nicer than it was. And therefore you're going to charge higher rent once it's done. And that's really what you do. And that raises your net operating income, or NOI for short. NOI is the real estate equivalent to EBITDA. So if you look at how a multiple would work on a stock or a private company when it's selling, they're going to look at the EBITDA and a multiple on it. And NOI is very similar in the real estate world. So what we're trying to do is grow that cash flow, grow that net operating income, and then sell it for a higher price. And there's usually pretty decent returns on value add because you're adding value. Further up the spectrum is opportunistic strategies. This is where we like to play the most. We do value add, but we love opportunistic strategies. This is your highest return. What this is when you're taking something and you're completely redoing it, you're knocking it down and rebuilding it, or you're buying land and building something from the ground up, or completely refiguring a block or piece of real estate. These are some of the best returns you can make. And now it does have a construction risk associated with it. We own our own construction company to help offset that risk as much as we can. But that would be further out on the risk return spectrum. And honestly, the returns are pretty close to private equity at that point as well. So that just gives you an overview of where different real estate places would fall. And this is irregardless of property type. So I just want to mention that as well. Okay, so now that we've done that, where do we invest? Where is a good place to put your money? Well, we live in Dallas, Texas, and we're pretty high on Texas. So let me explain why. We've got a lot of number ones going on right now that really play in our favor. If you've got number one job growth and you've got population growth, your real estate's going to do really well. That's kind of the most important things that you need to look for. Corporate relocations are a big deal. A lot of people are moving to the South for various reasons, and that helps our real estate markets. So if you're going to invest in real estate market, you need to understand, what does that local economy look like? And then GDP growth generally comes along with it, which obviously helps perpetuate that economy. Some interesting facts about us as well down here is that we're the number one exporter in the US, and a lot of that is our energy business. Obviously, we're the energy capital of the world. We also, for oil and gas, And with oil at $100 a barrel, that does not hurt right now. Another thing that's interesting is we also have Tesla. Elon Musk is in Austin. So we kind of play both sides of this game, which is a fantastic overall picture for the state of Texas. And lastly, we have no state income tax. Why do I bring that up? If you invest in a private placement or a real estate deal around the country, and that particular state where the project is located has a state income tax, guess what? Even though you don't live in that state, you now have to file a tax return in that state. A lot of people don't realize that. I've got one investor who is sort of complaining, sort of laughing that they had to file 14 different tax returns because they're in deals all around the country. Now, they're a sophisticated investor. They knew that going in, but they also admitted that's one reason they like investing with us is the majority of our stuff is in Texas. Now, we've done stuff in California and New York and other places, but we do like our home state. It's been a great place to do business. And a lot of our investors from around the country appreciate not having that state income tax that we have here locally. So next up, how to invest. Now I'm going to go back to the basics a little bit to kind of explain how these, if you've never done a private investment or a private real estate deal, I want to explain how this works. So we have a capital stack just like you would at a company, and you'll have your debt and your equity. And the vast majority, if not all, real estate deals are private partnerships. A real estate limited partnership is a private investment that pools investors' money or funds to buy, develop, build, redevelop, and then eventually sell those properties. So as you can see from this graphic, I want to make sure everybody knows. So as a limited partner, which is what an investor would be in this partnership, you have a general partner and a limited partner. The developer is the general partner, and they have full liability for everything. The limited partner or the investor, you're only liable for the amount of money you invest, period. You do not have any excess liability beyond your investment, and that's why people like it. So it's, so from a liability standpoint, it's similar to other investments. However, you are on the equity side of the equation. So let's say we buy a $50 million or $45 million property, and we need another $5 million on renovations. So we have a $50 million budget. Well, we can probably get 37, 38 million ballpark worth of a senior loan from one of our lenders or a bank. And we probably need to bring 12 to $13 million to the table in equity in order to get that deal done. Some of that money will be our money, and the rest of the money will be for outside investors. And that's where you guys will come in, or our current investor base will come in. We'll offer it to them and explain the opportunity. And if they review the risks versus where we think the returns will be, they may or may not invest in that deal. And that's how these deals work. It's not any more complicated than that. I like to simplify this. So in the blue box, we got an overly simplified explanation is a developer will create an LLC and they'll issue a PPM. PPM is a private placement memorandum. That is the equivalent of a prospectus, but in the private world, right? So if you invest in a stock or a mutual fund, you got a prospectus and nobody reads it. However, in the private world, we do recommend you read the PPM though. It's going to go through the unique risks of the specific project. It's going to go through the pro forma. It's going to have the debt. It's going to have the business plan, and it's going to have basically a case for why that developer, or us in this case, think that you can make X amount of return if you invest with us on this project. So it's very important. So investors will buy units in the LLC and thus become limited partners, and the LLC owns the real estate. All gains, all losses are passed through to the limited partners or the investors in this case. You'll get a K1 every year. And that K1 is where you'll get those passive losses that I referenced earlier. Those passive losses can be used to offset a passive gain in the current year. And if not, once the deal closes, those passive losses turn to active losses, and they go to offset any active gain, such as the deal you're in with us and or anything else that you're doing. So it's incredibly tax advantaged. I'm not a tax advisor, so obviously this is a personal situation and every deal is different. But in my personal experience, I've noticed that roughly half of the long-term gain is offset by the depreciation and other losses that we can take. And that's a really neat way to invest. And if you look at the taxable equivalent, it adds several 100 basis points to the overall return. Now, so that's kind of the overview of how these work. How do you invest? Well, you can invest after tax through an individual account, a joint account. We have a lot of people that'll invest through their LLCs or set up LLCs, and a lot of folks will invest through their trust. So if you have any trust that you've set up for estate planning, it's a great way to invest in these type of deals. You can also use your IRA or Roth. You just need a self-directed IRA company Typically, they're trust companies. There's a few self-directed checkbook control type companies out there. If you have interest in learning about that, we'd be happy to share with you our favorites offline, as well as some of the ones that we've had not so great experiences with as well. We always are happy to share from our experiences. And then lastly, you can do a 1031 exchange. And a 1031 exchange is when you're exchanging a rental property or an investment property into another investment property and deferring the capital gain. So if you're not familiar with it, I'm going to take 1 or 2 slides on it quickly. These are for people that are tired of being active investors and they like the idea of going to become a passive investor. So there's 2 ways to do this. You can do it all yourself, or you can invest your money with a big professional shop like us and just be one of our investors on that capital stack that I just showed you. So instead of having to get the phone call at midnight about a toilet breaking, et cetera, I mean, I've done this myself. I say this is a massive change that's going on in the industry where a lot of people are moving from active to passive. I did it myself. And I'd say it's the full cycle round trip of Robert Kiyosaki's Rich Dad Poor Dad book that came out, gosh, nearly 20 years ago, where we all went and bought rental houses. And a lot of folks, it works, but it's work at the same point. So if you have a good job and you don't really want to have a second one, you might consider passive real estate investing to augment your current portfolio, which is the purpose of this presentation. And so what's happening is people are selling their investment properties and looking to move into a more of an institutional type offering. And the way you do that is what's called a DST. If you're not familiar with a DST, I know there's a lot of text, but I got to explain what this is. It's a Delaware statutory trust, and it allows you to avoid going like to like or active to active. This is how people go. If an investor wants to no longer have an active role in a piece of investment property, they want to go passive, but maintain the tax favored status of deferring that gain, they do it through a DST. I bring this up because we'll have one coming out next week. If anybody has a 1031 exchange and would like to learn more, we'd love to visit with you. The best way to explain this really is the second paragraph. DSTs allow for a fractionalized interest in a trust, very similar to the LLC, and it allows a smaller investor to invest in something they'd never be able to buy on their own, such as a $57 million property that we closed on yesterday in a really hot part of Dallas, a beautiful property. Anyways, what it does is the investor still enjoys the same tax advantages as if they own the property themselves. All that pass-through depreciation and amortization still goes down to the investor, but you deferred 100% of your tax on the sale of that property, which is really, really nice. Now you have to be an accredited investor to do that, as you would with any of our stuff. And you got to understand that these are illiquid investments until the deal is done. Most of our investments are 3 to 5 years. Other people's, I've seen DSTs go as long as 10 with other folks. Just depends on what you're looking at. You do need a qualified intermediary, and there's some IRS rules you got to follow, which the qualified intermediary is called a QI for short. They're typically part of a title company. And once again, we've got our favorites, and we've got some that we've done a lot of business with that we'd be happy to refer out if that's of value to anybody that's listening right now. Okay. So we talked about why. We talked a lot about, where and how. What do we invest in? What is BV like? This is what BV likes right now. We like multifamily. We like industrial. We have always liked mixed use, and we love vacation homes right now. They're booming. So I'm going to take the next part of the presentation. I think we got about 8 minutes or so left before we have questions to talk about what's left. And where to invest. So multifamily. Multifamily is one of the best ways to keep pace with inflation because we can raise the rents every month. There's a new lease coming due. And so you have the ability to take an old lease that was done a year ago to market rents, and market rents are generally higher. Now in Texas and in the South overall, we are very underhoused. The amount of population growth that the South and Texas has seen overall versus the lack of construction have created an amazing supply and demand imbalance. And therefore, just as an example, we raised rents across our portfolio 4 times last year. And we're starting to look at whether we should do it again already. So it's really interesting how these things are moving. Industrial is the blue chip in real estate with the e-commerce boom and the onshoring of manufacturing that is still happening. It's a great way to invest. Industrial has less ups and downs. It's kind of the steady Eddie in the real estate space. It's a great way to get cash flow. So for cash flow investors or income investors, industrial is a great way to go. Mixed uses investments are your home runs. right? They take a while, but they spread the risk across multiple types of asset classes in the same investment. And then vacation home buyers are booming due to, I'm going to show you an amazing stat here in a minute, due to obviously the new remote work environment. And a lot of the buyers for these properties are high-end buyers, and they're not as concerned with the rise in interest rates, which is one reason we like the asset class. So let's talk about multifamily. This is a property that we took. This used to be raw land, and we turned it into the picture you're looking at right now down in Houston. It is a 330 unit ground up construction project. And I'm going to show you the numbers on it in a second. Just a couple things. Multifamily does have preferential lending that allows us to get longer terms and lower rates than you would find anywhere else. For example, we have a multifamily project that we did, and we got a 40-year amortization on it. Isn't that crazy? But that is sometimes something you could do. One last thing to point out here in multifamily, if you've not invested there, is there's a diversification of rent is one reason people really like it, in that you might have 300 units in a property, and therefore you could have up to 300 different companies paying the salary for their employees who live in your property. And that's a great diversification of income. So if you hit a recessionary period, if 3 or 4 of those companies have issues, you got all of the others that don't. And so multifamily is a good place to go if you're concerned about a recessionary environment. So here's how this worked. If you think back to that capital stack diagram that I showed you earlier, we have $30.5 million in a loan. We raised $6 million from investors, secured in March of 15 is when we did it. The total project was $36.5 million. The project was finished and sold in April of 19 for $48.8 million. And that's a profit of $12 million on a cash investment of $6 million. So that's how we get a 2x. It's a multiple on invested capital is what we call that. That's basically doubling your money. We doubled investors' money in about a 49-month period. This is a middle of the road deal for us. This is not a home run. We've had much better. We've had a few that weren't this good. But this is what we would consider a middle of the road deal. And this is one reason we like construction, is we can create those type of returns in about this one was four years, but our goal is a 3 to 5 year period. Okay, industrial buildings that look like this. Manufacturing, warehousing. Think of a lot of bays with trucks that are taking things places. This one that we're looking at now happens to be a manufacturing facility. These use triple net leases. If you don't know what those 3 N's mean, they stand for triple net. And triple net means the tenant is typically a $1 billion company. They are responsible for the taxes, they're responsible for the insurance, and they're responsible for all the maintenance and upkeep of that facility. For all my rental homeowners on the line right now, could you imagine if that was the deal you have with a rental home? That'd be fantastic, wouldn't it? That's what we do in the commercial space. We sign triple net leases as often as we possibly can. It's the best way to own real estate, because then when you get the rent, part of that rent's not going to pay expenses. 100% of that rent's just cash flow. And that's why this is a good cash flowing vehicle. So what does it do? Normally you have 10 to 15 year leases. You typically will receive monthly income. We have a fund out right now. If you go to our page, you'll see a little bit about it. And we're about 50% through on that fund. We have 6 properties. We're about to have a 7th. And the goal is to get 10 to 12 properties in a portfolio, package that up and sell it to a larger institution about 3 to 4 years down the road after you've made some income along the way. And you'll get a premium on the exit. These institutions you'll make some good money on the exit that way, because they don't want to buy these one at a time, but they'd love to buy a portfolio of high income producing real estate, especially in good areas. They love triple net. They love industrial. They love Texas. So it's a really good play for us. And our investors that like this. And it pays a pretty good income stream. Our current fund is paying 7% and it pays every month. Obviously, that depends on the underlying assets. Okay, next up, mixed use. Mixed use is where you develop multiple property types in the same area and you really change that area. It's in high demand for employers and employees. You know, you can live, eat, and work all in the same area. It's kind of creates a destination, if you will. And it is a diversification of income streams, because you might have an office building, you might have a hotel, you might have some retail, you might have multifamily, you could have all kinds of things kind of diversifying your income stream if you invest in these type of deals. Now, they do take longer. That's my last bullet. I jumped ahead. They're very pedestrian friendly. And so the nice cities love them because they reduce congestion. Because you don't have to drive. It's all right there within walking distance. It's a really good utilization of space. And it actually, as a developer, it saves us money, because we have unified utilities that way. We only have to tap into the utility once. We don't have to do it each and every time per product. And that saves us money on the development and construction side. Like I said earlier, they are longer time frames, but they do have potentially higher return metrics. So depending on the type of investor, you may appreciate that. Now, lastly, I'm going to finish up with vacation homes. This is a huge growth opportunity right now, second home investing. Look at this statistic from Redfin. Home buyer demand for second homes is up 87% from pre-pandemic levels. I mean, that's still amazing every time I read that stat. So why? Well, a lot of it's driven by today's remote work environment. How many folks do you know that are only going into the office, if they're still working, that is, 3 days a week? You know, and they have 4 to 5 days and they work remote the rest of the time. So they can have a 4 to 5 day weekend anytime they want. They can work remote for a week on end if they want. And a lot of people that have the money or the means are finding it advantageous to their life and their mental well-being rather to have a second home. And here's the other thing. High-end buyers aren't as concerned with interest rates because most of them borrow against their investment portfolios. I'm sure there's many of you on the line. If you got a lot of money in brokerage, a lot of times those brokerage houses will let you lend at ridiculously low rates. And the collateral is your investment portfolio, your stock portfolio, and they'll lend against that. And that's how most people are buying these second homes at really low rates, so that they're less interest rate dependent. And a lot of them, frankly, just buy all cash too, because they can. So quick review there. Oh, one more thing. So you actually have a mixed use potential on these vacation properties too. You could have a hotel, you could have homes, you could have, in this particular picture, a marina. You could do other things to create multiple sources of income. You do get development like returns with vacation homes. Another reason we like it. So for example, you might wait a year or two for income, but then as they start selling, then every quarter you're going to start getting paid. And usually they're pretty good paydays when that happens. Lastly, owners also are pretty apt to buy in vacation homes with the boom of VRBO and Airbnb and all the other stuff like that to allow short-term rental income. That does help offset a lot of the cost needed when you buy one of these homes, because a lot of these are higher end homes nowadays. But the rental income definitely helps, and it also spurs a lot of the demand for it. So I am about through my presentation. I want to open it up for questions. We talked about the why, we talked about the where, the how, and a couple other things. And the question really to the group is, are you ready to add multi-million-dollar projects to your portfolio? If you are, we'd love to talk to you. Here is how you can talk to us. And I'll go ahead and stop now, Dylan, and see if there's any questions in the queue that we can answer.
We have a couple of questions ready for you. The first one is, what is the minimum investment needed to get involved with VV Capital?
Minimum investment really depends on the deal. Some of them are 100,000, some of them are 50,000. It really depends on the specific opportunity. So that's a little bit, but generally it's going to be in the 50 to 100 range. We like to create relationships with people. And if there's a good reason to sort of do a favor for somebody, that has happened before.
We have somebody actually asking, after a 50K investment, when will returns come in?
Well, that too depends on the deal, right? So an income play, like in an industrial, you get paid the very next month. If you're doing a development, like a ground up construction, you might go 3 years with nothing, and then we sell the property and you get a giant windfall. Projects where there's income along the way, you might get paid quarterly. It just depends on what we're doing and how quickly there is income at that particular development. So it's very custom to what we're doing. The vacation homes generally have about a year lag while we start developing. And then as they start selling, we start to see income come in. Like I said, a ground up construction multifamily, that's not going to pay anything for 3 years, but you get a pretty giant pop when we sell that thing. So it just depends on what we're doing. The income plays and the value add plays, those will pay along either monthly or quarterly as we go. The typical time frame for what we're trying to do is we're trying to exit an opportunity in 3 to 5 years. This isn't a perfect science, but we do try to, our internal investment metric is, can we double investor money in a 3 to 5 year period? And if we can do that consistently, then we're a good investment partner, is how we look at it. So hopefully that answers the question.
I think that just about covers it. Next question we have is, what is your advantage compared to a competitor?
That's a very individual answer. We own a broker dealer. And we do that because we want to hold ourselves to a higher level, more of a fiduciary standard. The private deals are not heavily regulated by the SEC. So in order to provide an extra layer of confidence to investors, we have a broker dealer. That means we're audited by FINRA. So we have to dot a lot more I's and cross a lot more T's than some of our brethren do out in the industry. And we hope that would provide a little bit of comfort. Our founder was one of the top real estate lenders in the country in a prior life. So we have amazing expertise on the debt side of things. And as most people in real estate will tell you, a lot of the values in the network you have. I'd say 9 out of 10 deals we do, we buy off market. We very rarely ever will buy something on market. People bring us opportunities because they know we have the ability to close a deal. And so we'll get the opportunity to see things that other people may not be able to see. And that's where we get a lot of our off-market deals. For example, we bought 2 student housing properties last year out of bankruptcy. Got a phenomenal deal on those. Other people never even got a shot at that. So hopefully that helps a little bit answer that question.
I think that just about covers it. And unfortunately with that, I think we are out of time. But once again, I'd like to thank you so much for joining us for this awesome presentation. And to all of our attendees, please feel free to go check out the BV Capital virtual booth and check out those downloadable assets. I'm sure there's a lot of helpful information there if you're looking to invest potentially in BV Capital.